Hello, everybody, and welcome to this edition of the In Markets Inside podcast, brought to you by Standard Bank. My name is Godfrey Mutizwa. As we race towards the close of the year, we look back on the year that was. We look at the unique market trends and themes that defined 2024. Without doubt, one of the big stories emerging out of the Africa region was the disinflation picture. According to the International Monetary Fund, inflation across the regions remains in double digits in a third of the countries. So what has been the response of monetary authorities to all of this? Joining me for a discussion today is N. Alika, Head Client Coverage CIB, and Godfrey Mwanza, Economist, Africa Regions. Gent and lady, welcome.
Thank you.
Thanks for having us.
Let me begin with you, Godfrey. I like to say that Africa is not a country. Many people laugh at me.
Absolutely not. I think you're right when you say Africa is not a country. That's more sort of applicable in the way that inflation is very disparate. The experience of inflation this year and going into next year is very different in East Africa compared to West Africa, compared to the southern parts of Africa as well. Overall, inflation is declining compared to last year. And will continue to decline next year as well. The IMF is right in that. But if you look at East Africa in particular, inflation is very low, very, very controlled, very, very subdued inflation. In the case of Kenya, obviously the sort of industrial hub of East Africa, inflation is over decades, over the last decade, is the lowest that it's been. I think there was a last print of 2.7% year on year. That's very, very low inflation. And the monetary authorities are responding with lower interest rates.
Sure.
Whereas if you look at West Africa, both the big markets we look at there, Ghana and Nigeria, both have very high double-digit inflation. In the case of Nigeria, over 30% because of the reforms that have happened over the last 18 months. And we're not seeing a decline in interest rates there from the monetary authorities. We think we'll see that in maybe the first half of 2025. Same thing with Ghana, right? Inflation is still quite high, above 20%. The process of disinflation is yet to really take hold in those markets.
Yeah. I want to talk to Anne about how companies are responding to this, but perhaps before we bring Anne in, let's talk a little bit, as you said, some of the monetary policy authorities have tightened, but just give us, if you like, a little bit of a picture in terms of how they are tackling this inflation, which in parts of the continent remains stubborn.
So that's a good question because, what matters also is not just that there's inflation, but also what's causing that inflation.
Sure.
So in the South, for instance, what's caused inflation is essentially a supply shock. You've had a really bad drought in countries like Zambia, Botswana, and Malawi as well. So when it comes to a supply shock, a central bank can increase rates, but the only thing that will really long-term fix that kind of inflation is increase in supply of, what the shortage is. And in the case of the South, it's electricity and food, right, affected by the drought and hydroelectric power. In East Africa, the inflation has been stopped. As I said, inflation is quite low in East Africa at the moment, and interest rates are actually going to be coming down.
Yeah. Absolutely. So, Anne, let's talk about how companies are responding to all of this, given the difficulty in parts. For instance, if you look at Southern Africa, part of the reason why we're seeing high inflation and therefore perhaps central banks being hesitant in terms of taking interest rates down is because this is externally driven.
Yeah, it's always interesting to listen to discussions around inflation and interest rates, because at the end of the day, it's how it affects the companies on the ground. Because all companies, in essence, they produce goods and services and they sell it into the consumer base. So looking at inflation, there are some companies who will consistently operate far more effectively than others.
Sure.
But the inflation has actually impacted the purchasing power. So what we see from our clients is constrained ability to produce the same good at a price point that the consumer can buy that. So even though in East Africa inflation is coming down, Godfrey, our clients see that too, the reality is it is after a prolonged period of time that has impacted the purchasing power of the consumer, and that inevitably means that clients have to be far more agile and creative in reducing their cost of production. And that sort of, if you're in Zambia, quite nicely segues into the challenge around availability of electricity and the need to use alternative sources of powers, which in and of itself increases the production cost.
Yeah. And when you look at that picture, is this something that is uniform across the continent in terms of how companies are navigating this?
In terms of how companies are navigating it, no, it's not uniform because the situation isn't uniform across the continent. If I look at West Africa, persistent high inflation has been a real challenge. Some companies, however, have been able to grow despite this. It means what has happened is they are effective operators, they're extremely efficient, generally they have the scale. So what has happened is they've been able to take market share from other companies. That reduces the competitive aspect.
Sure.
So that'll be interesting to see in 25 and 26. But the better off operators have actually grown and have grown quite significantly.
Let's talk the macro picture. In terms of the countries in particular, when you look at foreign currencies, 2024 was notable for two big devaluations. There was one in Nigeria, I think at the beginning of the year, and then we also had Ethiopia come in. Give us again a little bit of a granular detail, if you will, Godfrey, in terms of the situation that you're seeing as far as currencies are concerned and how obviously they're impacting companies this way. Anne will come in.
Yeah, absolutely. I mean, there were big devaluations, as you mentioned, Nigeria in February 2024, and that was a continuation of a process that started when the new government, they're not so new now, just over a year now, came in middle of last year. So there was a devaluation middle of last year, a devaluation early this year, and you've seen quite a dramatic shift in the policies that govern the way foreign currency is managed in that country. We think it's positive, but
Sure.
it is one of those things that does come with pain in the short term. And in the long term, the hope is that that's going to create a much more sustainable foreign currency market. You're already seeing increased in liquidity, dollar supply from foreign investors, and a much more two-way market than what you saw before. Overall, on the African continent, one thing that's positive is that this year you've seen lower current account deficits.
Right.
And your current account basically just is how the external balance of a country is accounted for, and that's really comprises of trade, and in the case of countries like Nigeria, a big part of that's also remittance. Overall, the current account in a country like Nigeria has improved quite dramatically. Remittance flows has increased. The oil output is also increased, or oil export revenue is also increased. So the situation in a country like Nigeria on the current account is improving. You're seeing that across a lot of different countries as well on the continent. In the case of Ethiopia, that was really dramatic. It's a historic devaluation. The embrace of more free market, liberal pricing of currency and other things in the economy was a real change of direction for that country. We're hopeful long term that also, again, it creates a much more sort of sustainable market.
And I imagine, and that increases costs for companies, right? One, the challenge of finding foreign exchange, and then secondly also, of course, the issue of dealing with costs that are unique in their own markets.
I think really the story for 2024 has been some easing of availability of US dollars, which is, I think, what Godfrey was talking about. 2023, when we looked at Nigeria or Kenya, to some extent Tanzania, a little bit in Malawi, it was actually the availability of dollars that was a real problem. So that has eased in 2024. So whilst the cost in some markets, Nigeria, was much, much higher, in Kenya it came down. So in Kenya, if you recall, they were able to raise another Eurobond. The market was far more accepting of that. Availability of dollars was more prevalent. So that reduced the cost of imports in Kenya. And if you think of the continent as a whole, so whilst Africa is not a country, Godfrey, across the continent, we still are primarily import dependent. So the cost of the dollar is quite important in terms of the production of goods and services and the price at which it is sold to the consumer. But availability, far easier on the continent overall. Still some pockets of challenges. Tanzania is still a challenge. It comes through eventually. But we would like to see that ease. From a company's perspective, what has been the actual impact? And it's useful to look at the continent in the regions. When I look at East Africa trades quite a bit by itself,
right,
but within itself. So whilst the traditional view, it's Kenyan companies exporting into Uganda and Tanzania, we do see a lot more of the Tanzanian companies exporting into Uganda, and increasingly a growing quiet confidence from Ugandan companies, both exporting into Kenya and to some extent into DRC. So the Ugandan companies who historically have not exported a great deal into Kenya, for them the availability of dollars has really surprised them, because that's not an issue in Uganda. Now, those are sort of the practical challenges and limitations we've seen on the ground.
Yeah. And you want to come in?
Sure, yeah. I mean, it's such an important point that Anne raises. Tanzania was actually a very interesting surprise for a country like Zambia as well, trading into Zambia as well, not just to sort of traditional East African trading partners.
Yeah.
So, El Nino and the drought that caused the output of, all maize and other sort of foodstuffs in the southern region in Zambia and in Malawi. We had in Zambia, the harvest was about 1.5 million tons of maize, as opposed to 3.2 million tons in 2023 because of the drought. A lot of that gap was met by imports from Tanzania.
Yeah.
Right. There was a government-to-government deal where Zambia was importing 650,000 tons from Tanzania, and Tanzania had a bumper harvest with estimates between 8 and 10 million tons. So I think that's a very important point in terms of trade between countries, not your traditional just the East African community in the case of Tanzania, but also to the south on what happens.
Yeah, I was going to say actually East Africa is unique in many ways, isn't it? The most integrated region probably out of all the major regions across the African continent. And then also in terms of growth, the growth engine for the African continent for the past few years. We'll talk about the growth picture. But I wanted to know from you, Anne, when you look to West Africa, how has that picture been in terms of how companies have been coping?
Yeah, Nigeria being the largest economy has continued to be a challenge. But if I think of the story of Nigeria, if you go back 3-4 years, there's been significant focus on backward integration. And if you recall, the central bank in Nigeria for a long time was actually making available relatively cost-effective sources of funding so companies could focus and invest in an ability to backward integrate. So that to some extent reduces some of the pressure, but what it really did is perhaps concentrated to particular players. Nigeria, the devaluation of the naira has really impacted companies.
Yeah, and we've seen it in the results, right?
We've seen it in the results. You see it on the ground. You feel it when you speak to the consumers. You feel it when you're speaking in particular to the fast-moving consumer companies.
Sure.
Consumer packaged goods. They have had to be extremely creative. And I think it has made some of the foreign investors think very, very deeply and keenly as to what they want to do in a particular market.
Yeah, we've seen a few exits, right?
We have seen a few exits, which to some extent were a surprise because those companies have been in Nigeria for a very long time. But ultimately, people make a call based on what they expect going forward and based on the volatility and unpredictability that is that impacts their businesses.
Tough picture. Why not talk about happy things? Let's talk about growth. I think often we talk about Africa and we talk about our challenges, but we forget that we've got some good story going. And one of the good stories we've got going is on growth. The IMF says in sub-Saharan Africa, for instance, we're home to 9 of the world's top 20 fastest growing economies this year. I can mention Rwanda, Ethiopia, Senegal, etc. Godfrey, give us the granular detail.
Sure, absolutely. It is very much a positive picture. I think just to take a step back, if you look at the sort of last 24 years, sort of the first 24 years of the century, we've had kind of a two-speed sub-Saharan African growth picture. In the first 14 years, we're growing something like 3 times, per capita faster than the rest of the world. We slowed down a lot between 2014 and now, and we're picking up again. There was a period when sub-Saharan Africa was the second fastest growing region in the world. Obviously, East Asia, particularly China, was number one, and we lost that silver medal, if you will, sort of between 2014 and more recently. But we're getting back that mantle, and going forward over the next 5 years, the expectation is that Africa will become again the second fastest growing region in the world.
Yeah, I want to know who's growing and why. Because often when you look at the continent, there's a distinction between the resource-rich countries and countries without natural resources.
Right.
What are we seeing this time around?
I think that story, by and large, will continue. The reason why you have resource-dependent countries growing slower is because they sort of focus all their energy and resources towards that resource, as opposed to being more diversified.
Yeah.
So in East Africa, we keep on going back there. It's just generally more diversified. And the thing with economics, like your savings account, there's an element of compounding, right? So you already have a pretty diversified economy. You can grow in sort of multiple dimensions. If you have a very concentrated economy, it's harder to diversify at the beginning. So I think in the short to medium term, I think growth will still be mostly driven by the more diversified economies, particularly in the East. The countries that you mentioned in the West, countries like Senegal, quite diversified, now add oil to it, right? Sure. Ivory Coast, quite diversified, a lot of infrastructure investment going on there.
Yeah, one of the interesting points that's been made is that while you're seeing this very happy picture of accelerating economic growth, it's in some of your smaller economies. The big guys are laggards. So your Nigeria, your South Africa, for instance. But I want to know if that's a picture that's mirrored on the companies.
It's an interesting question. Actually, when you asked about happy themes and do we see growth as one, most definitely. And where does it play out for me? Ultimately, at the end of the day, I run a client business. So unless my clients are growing, unless we can see sectors and geographies where the clients are actually growing, my business wouldn't grow. But we don't talk about a lack of growth opportunity for us, which means we're seeing it in our client base, in particular sectors and in particular geographies. So where am I seeing some growth? You talked about exits a little bit earlier. But those exits were not companies simply abandoning their businesses and moving away. They were selling their businesses to entities that have the capability and ability to operate effectively in that market. And those are companies that have actually grown year on year, if I look back to the last 10 years. And I see no reason why they would slow down. So certainly within the consumer packaged goods, fast-moving consumer goods, we're seeing domestic businesses grow quite well. It makes sense. They're close to the client. They're close to the consumer. They adapt. They are more agile. We're also seeing a lot of growth in the sectors that are necessary for everybody else to grow. So Godfrey spoke a little bit about energy earlier. So we're talking about energy in South Africa, and that's been a fabulous result.
I want to talk a little bit about that.
I mean, it's been incredible.
Yeah.
And I think everyone in South Africa should be proud of themselves.
What about the regions? We speak about East Africa dominating, the integration in the region being an example for the rest of the continent.
The regions, so East Africa is very integrated, but if we think about scale in South Africa is much larger. Scale in Nigeria is larger. I think with the growth that we're seeing in Tanzania, some nascent growth in Uganda, and I say that with a smile because I am from Uganda, so it's good to see it. We can start to see scale potentially coming into East Africa.
Sure.
East Africa has always been a fairly consistent market.
Right.
Good growth, diverse economy, some predictability, but the question has always been around scale, and that's a question the external investors ask us. But on the ground, you have a lot of domestic businesses that are starting to grow, and that's always good and useful to see.
Yeah, absolutely. We, of course, while we ask for foreign investors to come in, local investors must be leading the charge for that growth to be sustainable. Let's talk about where the money is going. You spoke about energy.
Where is the money going? Money is going into energy. Money is going into infrastructure. Money is going into strategic minerals. I don't think we can shy away from that. But I think it's a positive story. I don't think it's a negative story.
Sure.
Often I hear people talking about, the external investors only want to come in, invest in the mines, be it in DRC or Angola or South Africa, and take the goods abroad. Yes, that is part of it. But with that investment comes investment in infrastructure. And with investment in infrastructure comes the ability to move goods, be they the strategic minerals or actually fast-moving consumer goods, which the people on the ground actually desire, need, and are a great signal of growth. Yeah. I mean, if you look at the DRC in particular, you look at Kinshasa. Kinshasa is a huge city. Yeah. And often we forget it's going to be one of the largest cities in the world by 2030. That means it is a city that is creating demand, not just from companies within the DRC, but from the surrounding companies.
Yeah, I want to talk about the DRC opportunity, but a little more color, please, Godfrey. I want you to put on your economist hat and talk a little bit about the energy story, because we know Africa is energy hungry, right? 600 million Africans still have no access to power. We've seen big initiatives, including one from the African Development Bank, working together with the World Bank. Let's talk a little bit about where that money is going in terms of energy. Is it traditional sources, or are we talking here about the renewable story truly beginning to attract the kind of money that we needed to grow at?
Yeah, it's a very, very important theme. When it comes to climate change and the impact we have seen, the drought have on the South that I mentioned earlier, and how that has crippled hydroelectric power generation in the South. One thing that I've seen is an increased willingness to invest in things like thermal coal. So solar is going to be a theme, thermal coal is going to be a theme, and anywhere where you can get investment to increase electricity output is, I think, what you're likely to see going forward, because that is, from a sort of macroeconomic growth perspective, growth is population growth multiplied by some kind of productivity factor.
Sure.
And nothing enhances productivity quite as much, particularly from the level where we are at on the African continent, than electricity. But just to touch on something that Anne said as well, in terms of investment in strategic minerals, that's also extremely important in terms of the model of the kind of funding that we get. So, for instance, we got a lot of debt from China and other sources sort of in the last sort of decades or pre-COVID. A lot of that was dollar debt, right? It paid for infrastructure, but not necessarily infrastructure that earned you dollars, right? So if you build a road, from the airport to town, that's great for commuters, but it's not necessarily going to increase your dollar earnings.
Gotcha.
But you borrowed dollars for it. But for these strategic minerals, even if governments borrow in foreign currency to build rail, for instance, to extract those critical minerals that you can then export, then that actually is more direct. It has more economic logic.
Sure.
Projects like that.
Absolutely. So our story around infrastructure is well known. I've grown tired of how big that is. Is that 100 billion? Is that 300 billion in terms of deficits every year that we can't find? And are we beginning to see private capital looking at infrastructure?
So the quick answer is yes. But in practical terms, whilst there is a lot of investment in infrastructure on the continent, the reality is the deficit is significant. And so we need far more of it, and we need the governments to continue to get involved. But where are we seeing this investment from the private sector? Ports, and ports are a really important thing. Logistics, and logistics at the end of the day is the way in which we move goods and people across the continent. Still a lot more to be done within that. And when you come to talk about the DRC, I think we should talk about the infrastructure for the strategic minerals,
Right.
because we will eventually connect East and West,
Right.
finally, which will also, I think, lead to significant development in southern Central Africa. And here I'm thinking of countries such as Zambia.
Right.
But we are seeing private sector funds, infrastructure funds that have a long life, investing in infrastructure assets. And that's really important because the life of the fund is consistent with the sort of returns one can generate from the infrastructure and the financing, the appropriate financing that's required.
You remind me of a conversation we used to have years ago about the fact that Africa is not short of money. We have got pension funds that are invested in overseas markets where they are earning sick returns when the opportunity at home is quite as large.
My personal passion,
Please share.
is actually what I call the trapped capital in the various pension funds. So I think we're all familiar with South Africa. South Africa is a large formal economy that actually works incredibly well. And many of those funds do invest in energy or infrastructure. And if you look at the asset managers, a lot of them are creating infrastructure funds. But you go outside of South Africa, whether you talk about Zambia or Uganda or Kenya or Nigeria, you have a lot of fairly large domestic pension funds. And that capital is trapped in one country. But our infrastructure needs connect one country to another. So to the extent that could be unlocked at least a little bit, I think we would see a significant increase in investment in the right infrastructure opportunities. And off the back of that, growth of consumer packaged goods.
Coming into, so let's segue into it. Let's talk about this wonderful creation by the political leaders of the continent. I think in terms of speed, of implementation, I have not seen anything as fast, and I've been around a few decades. Let's talk about what it is doing on the ground and practically how we are seeing. I want to talk companies, but I want to talk the big picture too, just in terms of whether we are beginning to see the kind of impact that the founding fathers envisaged when they talked about integrating the continent, and also those who finally implemented the vision. Are we seeing fruits yet?
I would say it's early days yet.
It is early.
It's very early days yet, which means in practical terms, if I look at the individual companies, I'm not yet seeing it. And that is not to disagree with anything you've said, because when I look at the regulations, when I look at the fact that the different countries have actually signed the various agreements and seem to be committed to it, then I think it will work. But it's only been a few years. And when we talk about the free trade agreement across the continent, I don't think it should be a surprise that my response is it is early days yet. It is also not a surprise that typically companies will grow their own market first.
Before they look outside.
Then they'll look at the neighbouring countries, and then they'll look further afield. So that takes time. So we're not yet seeing, for example, East African companies selling into Angola. We are seeing Angolan companies invest in DRC, in fast-moving consumer goods. That is not the same as saying that they are exporting into the DRC. So there is still some work to do. There's still some energy required to get it moving effectively. West Africa, we talk about East Africa being integrated, but from a West Africa perspective, you do see some commodities between Ghana and Nigeria and vice versa, between Ivory Coast and Ghana when it comes to cocoa. You see the governments collaborating on that.
Let's gravitate to the DRC. and talk about how big this opportunity is, in particular, given the growing interest we have seen. The United States has been talking about the Lobito corridor. We know that on the East African side, we've been talking about other various corridors that we've been creating. But at the center of it all is the Democratic Republic of the Congo. Let me share a little story about the DRC with you. I saw a definition somewhere on the internet. I can't remember who said it, but they said the Democratic Republic of the Congo is the richest country in the world in terms of resources, but in the ground. Let's talk about getting those resources out and the opportunity that it represents. I want to begin with you, Anne.
Yeah, I guess I wasn't really hesitating. I was just thinking about the significance of the opportunity. I went to the DRC for the first time this year, and unlike many people, I didn't land in Kinshasa. I landed in Lubumbashi and drove to Kolwezi. Now, for those of you who may not know, that is in the Katanga region. It's where the copper and the cobalt is.
The rich mining region.
Rich mining region. There are a number of significant mines that have been developed over the last few years. What's interesting about those mines is it takes time to build and develop a mine. But those mines have started to export their product. So those mines are now generating cash and revenue, both for the shareholders and for the DRC. Now, that talks to a significant amount of money that potentially becomes trapped in the DRC. So what are we now seeing? We're seeing the mine service companies also set up in the DRC. These are very large mines, and these are global service companies. I was both impressed and actually awed by the significance of the opportunity there. We went to see one mine that was that very kindly put up a chart of the large copper mines globally.
Sure.
And then made the statement, we are number 18, but Q1 next year will be number 2. And it's about the quality of the mineral and the ore that's in the ground and where in the ground it is. So you don't have too many deep mines. It's still surface mining. And it's surface mining because it is on the surface.
Sure.
It is not surface mining because people are doing the wrong thing.
Right.
And that's a significant opportunity both for the DRC and for the region because, of course, the DRC, that mineral must be exported in some form or shape.
Yeah.
Even if there is some processing that takes place in the DRC, ultimately it's going to be used in batteries elsewhere in the world.
Yeah.
And it'll attract revenue to the DRC, revenue to the region. The miners will demand and require investment in infrastructure in order to export their product. So there is a wonderful combination of not influences, a wonderful combination of incentives here. It is the miners who will need to invest in some form or other in the infrastructure.
Yeah.
And by that, I don't mean that they will put their own money in the ground, but you know that they're going to use the infrastructure.
Yeah.
That same infrastructure will move other goods.
And we're certainly hoping that some of that money will go into processes those minerals into value that earns the country and the people of the DRC more. We need to round up. And as we...
Can I just comment on that? I would certainly hope so. And I think...
It's not a dirty word, beneficiation, right?
No, it's not a dirty word at all. But let's look at it also from this perspective. Nobody wants to export soil. So even the mining companies are incentivized to do some processing in DRC.
Yeah.
Because I think sometimes we forget that. People are very commercial. Companies are commercial. Shareholders want a return. Exporting soil doesn't provide a return.
Sure. So we need to do more.
I think they'll want to do more themselves. That's a bit that I think many of us forget.
Yeah.
Nobody wants to export soil.
Godfrey, let me come to you and take the positive picture that we're getting from the DRC and then add to the story that we spoke about earlier about the 9 countries in Africa that are growing faster in the world than many parts of the world, and ask the question, heading into 2025, how does that picture look?
The picture is very positive from a growth perspective. As I mentioned before, we're going to reclaim our place as the second fastest growing region in the world, as sub-Saharan Africa. There will be some that will grow faster, some slower, but the average is going to be, according to the IMF, over the next 5 years, about 4.2%, which will be the second fastest growing region in the world. And that's important. 4.2% on average is maybe about 2% in real terms per capita, which is important. What you want for real transformation over a generation is just continued growth. You want sometimes it to be faster, some slower, but it just needs to be positive all the time and for a very, very long period of time.
And of course, that's got to be powered by the companies, right? Is that a picture that you also see?
Definitely. I mean, if I think about my own personal budgets and requirements from my boss, it's all about growth because the companies are growing. Maybe the one thing I will say from a macro perspective, we're still growing off a relatively low base across the continent. So the growth is important. I think it is positive. It needs to continue in the medium term to make a significant difference both to the quality of lives and the purchasing power of the consumer on the continent.
And on that happy note, we end it. Africa's inflation picture is improving, and its economic growth is accelerating, building scale in its companies. I want to thank my guests for tonight's program, Anne Alika, Head Client Coverage CIB, and Godfrey Manza, Economist Africa Regions. Until next time, goodbye.